Good afternoon, everyone, and welcome. I'm Gina Gonsalves from Dubai CommerCity, and it's a pleasure to be your moderator for today's session. There's a lot of conversation around how much venture funding this region has attracted in recent years. The headline numbers, the growth curve, the momentum, but founders on the ground will tell you a different story. Knowing that capital exists isn't the fair same as knowing how to reach it. Who writes the first check at your stage? What a fair valuation looks like without a familiar benchmark to point to, or how long it genuinely takes an investor to commit. That's the gap we are here to close today. Over the next hour, you'll directly hear from investors who make these decisions every single day with the goal of giving you practical, honest insight rather than the usual talking points. If you have a specific fundraising question, please flood them in the chat box so we can address them accordingly. With that, let's begin. To start us off, I would like to welcome Mr. Majid Morad, who leads our sales team here at Dubai CommerCity. Mr. Morad works closely with founders building exactly the kinds of businesses we'll be discussing today. And he'll share a look at how Dubai CommerCity is shaping the future of e-commerce in the UAE. Mr. Morad, over to you.
Thank you, Juno. Thank you for the nice introduction, and thank you all for joining. I'll be sharing my screen with some slides that we have prepared to introduce you to Dubai CommerCity and give you a better idea of how a free zone work and how we work specifically and how we can support businesses in Dubai. Just give me a second to share the screen. There we go. Let me know when I'm visible.
We can see that now.
Great. So, the Dubai CommerCity is a free zone, and I'm sure most of us, or if not all, we know what a free zone is. But in general, free zones are it's a piece of land or an area in the country that provides businesses with specific circumstances of how they will conduct their business in an easier and more efficient way that are more favorable to them. So what you get out of free zone as a business, you have the full profit repatriation, which means you are not bound to reinvest your profits, the profits of your company within the country. You can take all your profits back home and or through bank accounts, international bank accounts with no restrictions. And then we talk, there is also customs and tax benefits. So when you are in a free zone, you have more relief in terms of customs and taxation, depending on your business activities and the structure of your company. Also, the business setup itself is made more easier in terms of the methods and the tools that we provide and the infrastructure that free zones provide for company setup that makes the time shorter and processes easier and prices more competitive. And trade and logistics hubs. So also in free zones, it creates hubs for trade and logistics where basically these activities happens across different type of companies that are coming from all over the world, and they're competing and they're creating a hub in the area, which also boosts the businesses and the activities of those businesses within Dubai and also across the world. With the specialized ecosystems that the free zones offer, specifically in Dubai, you get to see different ecosystems that are tailored to your type of business, like what we do here in Dubai CommerCity, where we provide an ecosystem that is catering to e-commerce and digital commerce businesses, logistic businesses, where we provide them with infrastructures and services that cater to their business and help them thrive and sustain their businesses in the area. So that's an example, and there are different multiple examples in Dubai of such ecosystems. So let's talk about Dubai CommerCity. As a free zone, it is the first of its kind. It's dedicated to ecosystems and digital commerce, as mentioned, and it was a result of a collaboration between Dubai Airport Free Zone and Wasl Properties, an investment of a total of 3.5 billion dirhams, developed in the area of Mall in Dubai, next to Dubai Airport, 5 minutes drive from the airport. It's connected directly with the Dubai Airport Free Zone, and it is a leading hub for innovation and digital commerce. So, in terms of the services and the infrastructure provided. Additionally, the sustainability first approach that was this free zone was built upon by providing solar panel operated warehouses, EV chargers across the parking lots, wastewater recycling systems. And it's also obviously led by a team of experts, commerce experts, with more than 20 years plus of experience internationally and locally. So this is the layout of our free zone within the Mall area. So as you can see, it's consisted of 6 buildings to the left. Those are the business cluster, where we provide our different and variety of office solutions. And to the very right, you can see there is a big lot. That is our warehouse and logistic cluster, where warehouses and logistic services are provided. And in between, we have also created a social cluster to cater to all these businesses and to the communities surrounding us or surrounding DCC, creating a variety of F&B options and which we will come to see also with the expansions that are coming, that this area is trying to become a destination for not only businesses but also after working hours, entertainment and family place. So here's an overview of what we have done so far. So as a free zone that we are about 5 years old, we have accomplished a lot so far. We have more than 98% of occupancy, offices leased, more than 99% of warehouses leased. We are currently completely full on warehouses, but we're still offering services through third party, last mile delivery fulfillment centers and etc. And we have now more than 500 companies active with us. 10% of those are MNCs, with more than 150 companies that are doing e-commerce activities, with more than 4,000 client employees, which are the employees of the businesses that has opened within our community. More than 700,000 e-commerce orders goes annually out of Dubai CommerCity. I think someone has a question. Did someone raise their hand? Okay, sorry. And we also have more than 1.7 million parcels shipped annually out of our warehouses. So as a free zone, what do we offer? We offer a variety of services and products. First of all, it's the license. We are a licensing authority. We have different type of licenses that we offer to businesses who are coming to start their business here in Dubai, specifically in Dubai CommerCity. We provide with e-commerce license, trade license, service license, industrial licenses, general trading license, also dual license with the Dubai Economic and Tourism Authority, and talent passes, which is basically a freelance license. Now, next to that, the requirement for every business is to have an office, a registered address. So, and as I mentioned before, we have three different clusters: the business cluster, the logistic cluster, and the social cluster. The business cluster, where we provide different type of offices, starting of the minimum smart desk or smart office solution, which is basically a dedicated workstation in a shared area. Going up to furnished offices, and in between you have the fitted and shell and core offices, all with a variety of spaces that uh, suits different business needs along the way. So you can also start with a small office or a small desk, and then expand as you go with the variety of options that we provide. In addition, in the logistic cluster, where we have our dedicated warehouse units, in addition to the fulfillment services that are provided through a variety of third-party providers. And then the retail, which is within the social cluster, providing different type of F&B and showrooms, outlets of different shops. Now, other services that every company needs would be related to residency visas, golden visas, work permits for the employees, NOCs, bank account opening, and other services as well. Now, as a free zone, what also sets us apart from other free zones in Dubai is that we don't just issue you the license, hand you the key, and tell you you're on your own. We take care of you by providing a variety of integrated digital ecosystem services, by partnering with different service providers that provide services that goes from knowledge and innovation or market access and growth, with a variety of tools and within your reach, and with ease of access, affordability, and availability throughout the year. So these different services help businesses to start, to sustain, and to thrive within DCC. What are our upcoming projects? We are currently delivering two new projects coming up within the end of this year and beginning of the next year. A multi-storage fulfillment tower, which is the unique type of storage facility where we're building a tower that contains over 179 storage units with a capacity of about 600 square feet each, strategically distributed across the ground to upper floors, with, of course, accessibility options. 31 units with independent FCUs, which is the fan coil unit, which allows you to control the climate within the storage units, and central cooling system, ensuring efficient climate control. Also upcoming is our retail district, which now it says November, but it's slightly pushed to January next year. So we are providing more than 2,500 square meter of retail space. What we are trying to do is to create a destination where the area will be more vibrant, attracting more people to come, and also enjoy a different variety of F&Bs and retail outlets to become more a destination district that also operates after working hours. One second. Yeah, so that's about it. Here we're showing some illustrations, and no need to waste more time on this. Guys, thank you very much for listening. If you have any questions, here are my details. You can always reach out to me. Thank you.
Thank you, Mr. Murad, for the detailed walkthrough of Dubai CommerCity. It really shows that thought has gone through into building a space that supports founders, from the setup to the bigger vision for e-commerce in the UAE. That gives us a solid foundation as we move into the fundraising conversation. Thanks again for setting the stage so well. So next, I'd like to introduce Mr. Mohammed Asad Sheikh, Assistant Program Manager of Ursea Capital. Over the past 3 years, Mr. Assad has reviewed the conducted due diligence on early stage companies, helping helping build Orsea's pre-seed and seed portfolio. Prior to that, he spent time at Magnet and Microsoft for startups, giving him a well-rounded view of this ecosystem from multiple angles. Mr. Assad will walk us through what it genuinely means to be investor ready. Over to you, Mr. Assad.
Thank you very much for the intro, Juno. And I'm just going to go ahead and share my screen and walk you guys through a couple of slides. So please let me know once you can see these.
Yep, we can see the screen.
Perfect. All right then. So some of you may have done your homework on Ursea Capital, but just to give you a little bit of a background about us, Ursea Capital is a $136 million fund attached to Diaz, the entity which my colleagues from DCC are also a part of, and which also includes our offices, which are based in Dubai Silicon Oasis and Dubai Airport Free Zones Authority. So you could think of Ursea Capital as the VC arm of Diaz. The way we do our investments in our thesis is that we look at everything from the pre-seed, that's a very early stage, all the way up to the Series B stages. And the way we split our investments is twofold. The team that I'm a part of, which is the programs team and that runs our sandbox investment program, looks at everything from the pre-seed through to seed stage. And then for everything that is pre-Series A up to Series B in more of the growth stage categories, we have a direct investments team that looks into that. A few quick pointers about Ursea Capital. We are pretty sector agnostic in terms of what we invest in. We've got, as long as there is a tech component to it, we will look at it. And as long as there is some sort of relevance to the UAE, given that we are attached as a fund to the government of Dubai and we are a sole LP fund, we look at companies that have some, we call it a nexus to the UAE. But on the tech front, we've done everything and we're quite focused across different industries. We've done fintech, we've done health tech, we've done ed tech, we've done AI. So very, very broad space. And the way everything goes through Sandbox is kind of the gateway into Ursea Capital. And that then leads into discussions such as potential follow-on funding conversations, or even other ways that we can try and help our portfolio of companies. I'm also pleased to share that as of 2025 and 2024, for 2 consecutive years, we've been recognized as the most active investor in the UAE, which is a testament to our ambitions to keep investing and supporting early stage and later stage startups in the region. And for a fund that has only been around since 2023, our ambitions extend to becoming and continuing to invest in and doubling down on startups in this region. You might recognize a couple of these logos over here, but just to give you a bit of a context into some of our portfolio companies, we've done everything from the earlier stages. So if you look at the logos for Valeo, Cam AI, Prop AI, Circa Biotech, these were all very diverse companies. So you see prop tech in there, you see sustainability tech in there, you see pure AI in there, and health tech. Those companies all went through Sandbox and they're now Sandbox alumni companies. And then all of the other ones, you may notice there's a few that were more mature that we invested in directly from the fund. So we keep we always are on the lookout and we're always scouting for more companies and to grow our portfolio, which is already 60 plus strong and quite likely on track to exceed 70 by the end of this year. So I've given you a little bit of a background about Ursea Capital, but tuning into the context for this particular session, a lot of you might be wondering, or maybe you've pondered approaching VCs to raise capital for your businesses and your ideas. To make it very simple and in the interest of time, here's a simple framework that you could try and reference when you're debating whether to do some VC outreach and speak to investors about your company. So especially at the pre-seed and seed stage, which is early on. I imagine a lot of you who are in attendance today came up with an idea for a business, or you're past the ideation stage. To give you an insight as to how VCs think, for us, the reason why the $1 billion figure keeps getting thrown around a fair bit, it's not an arbitrary figure. There's a reason behind it. And the reason behind it is that in the business of venture, we're looking at returns that exceed 10x. There are many businesses out there that are great lifestyle businesses that are doing healthy with their cash flow that will probably give you a 2x, a 3x, a 5x return. But in venture, we look for companies and we bat for the fence that can hit that 10x plus threshold. The reason for that is, as VC funds, we don't just hedge our bets and we don't deploy capital into one or two or three companies. You saw that our portfolio is 60 plus. There are VCs who have much larger portfolios. And the reason for that is we like to invest across because we know that there will likely be companies who will not perform well, who maybe won't return the potential we were initially anticipating. And maybe there's some that will cease to operate not long after. So to account for all these scenarios, we always are on the lookout for companies that can hit that 1 billion threshold. So when you're coming up with an idea for whatever industry that you guys are in, you should, whether you prefer to validate that through secondary market research, through initial customer interviews, potential customer interviews rather, or a few other ways, that 1 billion is a good figure to keep as a reference point. If you if you look at it and seriously think that it cannot hit that 1 billion threshold, then you go back and revisit something that could potentially reach that mark. If you then pass the second stage and you think that, yes, this is genuinely something that could have a market potential of 1 billion and above, then you think, okay, how do I go about building something? We've often been asked at Ursea Capital what constitutes an MVP. Like, is it something that needs to be developed over time? Is it something that we need to obsess over, spend many months developing? To that, I would say that we are probably blessed in the era that we live in with all of the tools at our disposal. I would even say that if you come up with a tangible idea and if you lock in over the course of a weekend, you could come up with a very good idea as a very good MVP by using all the tools available. Think the likes of Lovable, the likes of Replit, all these tools that are now available have, there's no time like the present to build something and to reiterate on it. And as the name suggests, it's an MVP. It's not meant to be a perfect product. It's meant to be the first draft, and there will always be multiple iterations as you continue to build. After you've come up with that scratchy MVP, people will often say, okay, what's the proof that this is something that could become tangible and that could link back to becoming a good commercial prospect and in line with that $1 billion potential? That the next stage to then, after you've built your MVP, is the market validation and getting some traction. Now, usually the word traction with a lot of startups and founders typically correlates with revenue or money, which is true to an extent. Of course, as investors, our job is always to de-risk, and we're always looking at companies who have a modicum of traction because that helps us form a stronger and more compelling case when we take them to our investment committee. However, a lot of founders get hung up that traction has to equate to revenue. There are other forms of traction that should also be considered. Let's say for a very early stage company, traction doesn't always have to be revenue. It can be a growing user base. It could be in the form of, as long as there's some element of growth that has been observed over a few months. Is it as long as there's something to showcase that this is a growing company, even though it may not necessarily have revenue today, that it's not the see all and be all, so to say. I can only speak for ourselves at Ursea because even through Sandbox, we've taken companies from the pre-seed to seed stage, some that were completely pre-revenue. And even once we invested in them, they were still pre-revenue for a couple of months. And then later on, they started generating their first tranches of revenue. So to the audience out there, I would say that whilst revenue is an important indicator of traction, it's not the sole one. And it would be one of my key points for people in the audience to take away today. So I also want to touch upon this briefly. I know that we may not have the time to go through all of them, but There was an article that was written in Harvard Business Review a few years ago, and I remember even reading this when I joined. I would encourage everyone in the audience who is considering approaching VCs or maybe wants to learn more about VC in general to read this article because it will give you a more fundamental insight as to our thinking and what we look for when we speak to founders. Couple of key points over here. One of the things that is very important when you approach VCs is, especially at the pre-seed and seed stage, is the caliber of the team, because ultimately the team are the captains steering the ship. And when you're very early on, when you have a very basic MVP, possibly no traction either, we look at the background of the team. Like, why are you the right person to build something? Like, by way of example, if you are someone who's had experience in the agricultural sector for the best part of, say, half a decade, maybe 2 decades, and you're looking to build something in agri-tech, that gives us an indication that you understand the industry. You are probably more in tune with the pain points of the sector, and you're more likely to understand and appreciate it. If you were to use that experience to build in, let's say, something to do with something completely different, like let's say sports tech, can you build something in there? Sure, like why not? But would your fit be as strong as the former than the latter? Probably not. So the team, it's also it comes down to how we look at when we interact with founders, what their characteristics are. When we bring in a cohort for Sandbox, we spend a lot of time with the founders on an individual basis to try and plot their characteristics, their traits as well on an interpersonal level. Whilst that's not the sole factor, it's an important one because ultimately you do business with people that you think is someone you could get on with, and you could see that they have the certain traits to become strong founders. So team at the very early stage when you're looking to fundraise is a very important one, and I'm sure a lot of other VCs would also agree with this. Another important part is the growth of the market. This goes back to my previous slide about the $1 billion potential. This is important because if you're building agentic AI or agentic AI solutions in this day and age, naturally everyone knows AI is the hot topic right now for the past few years, and it's not going to go away anytime soon. So the chances are you're likely to build something that could scale and reach that threshold. Building typewriters in this era, maybe less so. So the market size is something that's a very important point when we look at the due diligence for the companies and whether we genuinely feel this is something that could hit venture scale levels, which is the 1 billion threshold. Another important consideration for us and for any VC is the defensibility of the company. Now, if you're building something that is very easy to replicate, it's something that the tech is built off the shelf, or it's something that myself or maybe someone else in the audience could go and build over the course of a week or something, maybe it's not as strong from a defensibility standpoint. But if you have something in place, whether that's you have some form of IP, you have some form of proprietary data for what you're building, you have in-depth knowledge, like you're a PhD holder, or there's many ways to look at defensibility. It can be your team's credentials, it can be the data that you have. So as long as there's something in there that would help us build more of a compelling case to understand why, if someone else was to start this tomorrow, why you would still have an advantage over someone else. So that's another important one. I want to quickly touch on one more point before I move to the next slide in the interest of time. Another important consideration for us when we look at companies is the cap table. So for context, I imagine some of you know what a cap table is, but a cap table basically is the list of everyone who has ownership in the particular startup. So let's say you've got your founders, you may have some friends and family on there, if you've raised some money from them, and possibly an investor. So if you come as a company to us and say, I want to raise from Oracea, but you have a cap table that has numerous entries, like let's say there's someone who's invested $1,000 here, $2,000 here, $3,000 here, you see that it gets very congested very quickly. And it also keeps taking away from the founder's ownership early on. You don't want founders to have a situation where they're very early in the stages of building their venture, but they've given away so much equity already, because later on the law of the game is you will keep raising consecutive rounds of capital, and that will keep diluting your ownership and the ownership of everyone else. So I recommend that everyone who's here, if they haven't already raised or if they have raised, to have a think about how they wish to structure the ownership and how much they wish to give away in terms of the equity in their businesses. To wrap up, I would say, as mentioned, as Juna pointed out, I help run the Sandbox program, and this session came at a very good time because we're just wrapping up our latest cohort, and we're now very actively scouting for our next cohort. So for Sandbox, we run 2 cohorts every year. We run one in February. We pushed it a little bit this year because of events, but now our next cohort is going to start at the end of September. So if anyone in the audience is from the pre-seed to seed stage, and if you're building something that has at least an MVP, and if you are based in the UAE or have a business that has ties to the UAE, I'm going to give you an opportunity today to scan that QR code. And if this is of interest and if you think Ursea Capital could be a good investor for you, to submit an application for Sandbox. The unfair advantage you guys have today is this referral code, which is Sandbox DCC VC Lobby. When you submit an application, if you use this code, my team and I, we can fast track your application. And because we get so many and a large volume of applications for every cohort, this would help us know that you guys were in attendance for the session today. And we could keep an eye on your application if you choose to submit one. The criteria that is mentioned is already there, but I'm just going to touch on a few more quick points. The way we operate Sandbox is twofold. So across 4 months, you have the first 2 months, which is the due diligence process. So if you were to be made an offer to join Sandbox, let's say by end of September, the next 2 months would be we would have workshops with our experts who could help guide you on different subjects, whether that's finances, whether that's tech, whether that's go-to-market, whether that's investor readiness. We have experts for all of these topics and more. And we could help you formulate your business in the sense if it's already got an MVP to get ready to pitch to our investment committee. At the end of phase 1, the whole purpose is to take you to our IC and potentially help put you guys in the best possible place to get an investment. If everything goes well, phase 2 of Sandbox, you receive the money from Ursea Capital. Our average ticket size in Sandbox is $150,000. We don't take a fixed equity stake. We look at each business because we take pre-seed to seed stage companies. So we wouldn't take a fixed percentage. We look at the existing valuation and we would arrive at a figure based on that. So you would get the $150,000 from Ursea. You would get access to office hours to work on bespoke things and bespoke challenges for your business. We would make warm introductions to fellow VCs who we're quite connected to. So if this is something that you think would be of interest to take your venture to the next level, we'd be happy to take your applications.
Well, thank you so much, Mr. Assad. That was incredibly insightful. You have given everyone in this room a much clearer picture of what it genuinely takes to be an investor ready, from the earliest pre-seed conversations all the way through Series B. It's easy to think readiness is just about having a polished deck, but what you have shared goes far beyond than that. And I think a lot of founders here will walk away with reassessing where they actually stand. Thank you for making the time to be with us today.
My
So,
pleasure.
so let's move on to the next part of today's session, our panel discussion. Joining us is a strong group of panelists who will be sharing their perspectives on what it really takes to close a funding round in this region. Please welcome Mr. Vaish Vallier, co-founder and managing partner of Red Tape Ventures, Mr. Santosh Dhirairaj, LVX GCC and portfolio at Let's Venture, Mr. Mayank Varyani, general manager of Angel Spark. This conversation will be moderated by my colleague, Mr. Kapil Bhamare. Thank you all for being with us here today. Kapil, I'll hand it over to you.
Thank you, Juno, for handing over the floor, and thanks, Asad, for your insights. Now, very interesting next 20 minutes of real-life conversations. To begin with, I have a specific question to Mr. West. Since you have come from a consulting background supporting, for an example, Karim sale to Uber, yeah, and you have multiple exits in last 15 years, and now you are an active investor, right? So what are the common term sheet mistake you have watched founders make from the advisory seat? What is your take on this part?
So I think, things are pretty dynamic with kind of the dawn of AI now. I think one of the things that we're seeing in the market is um, very high valuation expectations, right? Particularly around AI, which we believe will be repriced in the region, if not globally. But I think, that's a particularly big area to make a mistake now, right? Because if you raise on kind of this newspaper or headline type valuation, it creates this sort of golden handcuff type structure where you have to build and catch up to that to that bar. And when things go bad, you can face at a minimum a down round, but at a maximum, your company loses the ability to sort of pivot and go down new paths to kind of right itself because you've lost sort of the economic incentive to continue down the track for 8 or 10 years of what it takes to build a business. Your early employees can get wiped out. All of your founders or all of your investors can get wiped out. So I would say that's kind of the biggest mistake that we see universally, whether that's this region, whether it's any other region. And I think it's always good to model sort of down rounds, what that might mean for you as a founder. And then I think always accepting a lower valuation with a clean term sheet trumps high valuation and the golden handcuffs. So I'll leave it there and let the other panelists chime in.
Interesting. I think you have made a very important point regarding how AI is disrupting the business models, right? And sometimes that eventually impacts the valuation for both founders as well as the investors. Great. Thank you. Thanks on this note. So moving on to next question for Mr. Santosh. Mr. Santosh, LVX Ventures is bridging India capital market and Middle East capital market, right? However, these are two different markets when it comes to investor expectations, regulatory framework, and founder culture. So, what's the most underestimated or rushed thing which eventually will impact founder in the long run? What is your take on this? You're on mute, Mr. Santosh. Yeah.
Thank you, Kapil. Thank you, Juno. And thank you, Dubai Commerce team, for having LVX on the platform today. If I could set the context about what we at LVX do, LVX is a tech-enabled investment platform where we bring transparency and access to startups for investors. Right? So we have been doing this for the past 12 plus years. And over a course of time, we had invested in 715 plus startups and deployed about 210 plus mil in growth and early stage startups. And we have investors in the brackets of family office, HNIs, and institutions. Right. So to come to your question, in the form of cross-border capital, I'll give you a live example of what we have been doing. Right. So in our platform, there are investors from 60 plus countries, about 7,000 plus aggregated registered investors, and 920 plus investors from GCC and broader. Right? So for them to deploy the capital in startups operating in India and which are growing global would have been a different scenario if not LVX wasn't there. Right? So we simplify private market investment as an asset class for startups through pre-vetted deals, through a rigorous due diligence, and bringing clarity and investment opportunity for wealth creation for our investors. So, players like us facilitate these transactions so that there is no challenges in the cross-border capital movement. Thank you.
Okay. Interesting. I think you mentioned an important aspect about due diligence, right? So my next question for Mayank is around the due diligence part. So Mayank, you started with one person operation to having invested into dozens of MENA startups, right? So what's the most important due diligence you're not in a position to compromise, and you think that that's the most important part for you when it comes to assessment for the startups?
Yeah, of course. And like Santosh as well, I'll just give some context as well into Angel Spark and my role over there. So look, Angel Spark, we're an angel network. We invest in early stage startups, very much like the Sandbox program. We overlap on pre-seed and seed. We have a couple of portfolio companies in common as well, as the most recent Sandbox program as well. Um, it's a one-man army. I run the entire suite of operations for the company. That's everything from finding the startups, all the due diligence that happens behind it as well, and then all the reporting that happens to the 50 plus angels that we have within the network as well. We are not a syndicate. We transact more like a fund. So that means that if startups were to receive funding from us, it would be a one line item. But on our side, we have 50 or so angels who are very active and hands-on involved. Now, given the nature of that role, given the fact that I have, 50 plus angels who I'm accountable for on all things diligence, and then, I have to best represent the founders in the room as well. I leave no stone unturned, right? Everything becomes a question that an existing or potential future investor for Angel Spark is going to ask. So I need to have answers for everything of that sort. That is typically why due diligence for, an angel network or an angel fund, the timelines for due diligence would really vary. I think Ursea Sandbox have a nice experiential part as well there. Ours is a lot more, I'd say, legal and human driven as well, although in a different way. So we'll typically do our background checks into the individual, not formal kind of police records, but more, again, given I have 50 or so angels within my network, they work across multiple different sectors, multiple different fields, and they'll have their own network as well. So what we do is we'll utilize our network to do an informal background check on the founder, right? What is that founder like to work with? Can they attract the right talent? Can they adhere to client kind of demands and client requirements? Do they understand the space they're looking to solve? These are typically the questions that we will go in deep with the most because ultimately, early stage startups, investing in early stage startups is very much about the founding team.
Interesting. I think Asad also touched based on this point, right? The founder's portfolio and the core team understanding is, I think, very important when it comes to early stage investing. So thank you. Thanks, Mayank, on sharing some insights on this part. Now, my next question for Wesley is about the market timing, right? We are seeing currently region is going through challenges when it comes to current situation. So investors typically talk about, okay, I'm there as a long-term investor. But when times get tough, then that's where the real test happens, right? For the VCs. And obviously wants to be risk averse when it comes to investments and money. So considering this point, what are the different investors who say they are long term and the ones who prove the round happens during the difficulties, right? So, what's your opinion on this? What's the differentiation between the long term investors and a true long term investors for a business?
It's a great question, one we thought about a lot because we actually raised our fund, did our first close during basically the end of February. So we're raising in the midst of an unprecedented conflict in the region. I think that the people who have been around the region for a long time, I've been around here for 17 years. You start to see that a lot of the bigger companies and the unicorns that have emerged, let's say over the last 35 years or so, actually emerged during times of conflict. And I'd say like just probably it dates me, but and maybe some of the people on the call didn't know, but during the Gulf War, Network International was created, right? Like Network International, everyone knows. It went public, it went private, it went back public, got acquired by Magnati, right? So it's been all over the place, but it really is this kind of pillar and proof point that the Gulf War sort of triggered and started breeding unicorns in our region. you don't have to go back too far to look at sort of the BNPL space that was triggered by COVID, that created a few more unicorns. So, the kind of I guess talking point here is that times of adversity, crisis, tension in our region oftentimes have created some of the most interesting companies. So, for us, raising a fund in that crisis wasn't something that we set out to do. It was unfortunate, but I think we're able to sort of convince people that, look, we're a region that pre the situation that we face now was in the neighborhood of 17 different active conflicts anyway, right? So it wasn't so unprecedented that something like this would happen. I think, look, you can't sort of label yourself a long-term investor. Everybody says they're a long-term investor. Every fund that you talk to says they're a long-term investor. But the proof is in the pudding, right? Like, I think the people who you surround yourself with, and particularly the most recent conflict, are like, who didn't leave? Who still made it to the office? Who's still investing in building despite missiles going off? Those are the people, who you want in the trenches, the ones who are long-term investors. We're, have been around for a long time, have lived through financial crises, pandemics, wars, and a lot in between. We've built a business around all of these things. So I think that gets us in the realm of committed capital, of long-term capital. But of course, I don't see tourist investors as such a negative thing, because you have to sort of put your feet in different markets, right? So there's not so many investors in places like Iraq. If people want to invest in Iraq, there has to be a tourist at some point, right? So there is some period of tourism versus long-termism. But I think, all of us probably on this call were really tested during the current period of time. And I think one litmus test that you sort of had to face is like, are you here for the long term to build for the long term, or are you on the next plane out? So that's sort of my real world experience raising a fund in that period of
That's
time and
interesting, Grace.
investing.
I think, yeah.
We actually did our first investments in the middle of the war too. So
Interesting. I think you have pointed out a very right industry, let's say BNPL, right? I mean, I'm in this market for last 12 years, and at no point in time before COVID, I thought that I can get a iPhone on my monthly installment, or at least four installments over over a period of time, next 12 months, right? And I think if you see now, that space has evolved so much that we have a couple of unicorns operating in this, right? And consumers are also changing their spending behavior. So I think every crisis comes with an opportunity, and that's where I think the true test of venture capital fund works, I think. Yeah. Great. Interesting. Moving on to Mr. Santosh. Mr. Santosh, you have a very specific question about the founder behavior. Now that you're operating in India as well as in Middle East, right? So what are the typical MENA founders trait you find different compared to Indian founders when it comes to assessment from the venture capital funds point of view?
Yeah, I think so. The way that we look at LVX is a founder, irrespective of the geography, has a similar aspirations, right? The lens through which we look at and evaluate a founder or a company is fundamentally the same, but the way that we look at in the past few years has been evolving in the form of how are they building, right? How much of a process oriented are they, and how much of AI is involved in shrinking the time frame to build, and what's the quality of grade A team are they able to accumulate today, right? Since we are on the topic of geography, couple, I'd like to share a small example of a firm. Don't want to quote them, but they are operating from tier 3 city in India. In a span of 6 months, they are operating at 100 mil revenue generating, and they have team all across the world, right? So that really shows geography is no more a constraint. Capital is also no more constrained when the right talent is operating on the right product opportunity. But yes, partly investment per se is very regional specific, right? It also drives from what market are you operating at and what's the product or the service that in which you're launching yourself at, and then what's your right to win in that market. So if the product and the founder fits through the lens of an investor in the category of this geography, the second question what they look at is if in case the market is small, right? Is there process and systems put in the company which will enable them to scale up, right? So that's how we at least in LVX look at. Thank you.
Interesting. It is. I think you have brought a very unique perspective, founder to market fit, right? And I believe the VC funds or people who are working across the border, right? I think for them this is very important. Typically, we talk about product market fit, right? When it comes to consumer products or a technology products. So I think this is a very important perspective. I think this links back to what Asad was trying to mention
Well, but
during his presentation as well.
yeah, but if I had to take a one-liner on it, right? So in the founder market fit also, there's also the timing, right? Like for example, take the case of LVX. We have been at it for the past 10 years, right? So we did not start few years back and just coming to Dubai today, right? We have
Yeah.
built the process systems and operating playbook, and now with all humility, we have been working in Dubai market in building the ecosystem and not saying that our playbook is the right playbook, right? Evolving ourselves into the market, right? Like for example, we have launched a product called LVX Corridor, right? I'll be happy to invite the founders who are watching this today to apply to us, wherein we help cross-border companies on the commerce front, right? So our companies have also been invested in for about 5-7 years now, and they are growing cross-border. And we are supporting our invested companies to expand into GCC and beyond, right? Not just from the capital perspective, but also from a market opportunity, the network with the right enterprise customers, right? And in the likewise, there's good number of interesting, unique startups in GCC and UAE who are also looking at a large market time like India, right? And we could be the potential partners for them to handle and guide them, right? So,
Interesting.
yeah,
Great.
thank you.
So, in the interest of time, I have a last question for Mr. Mayank. At the same time, if anybody from the audience side has any question, feel free to use the chat box. We'll take the questions once we are done with the last question for Mr. Mayank. Yeah. So, Mr. Mayank, to close the questions on the yeah. So, Angel Sparks typically is investing and evaluating pre-seed to seed stage companies, right? Whereas there is a conviction of a founder and a pitch deck, and there is very limited real life action you see to prove the point, right? So at this stage, what convinces you or your network of investors? Is it about the founders, the numbers they pitch, or entirely something else you look at it?
Yeah, it's a good question, one that founders obviously ask a lot as well, and different VCs will have a different answer, but somewhere it also overlaps quite a bit, right? So Assad mentioned kind of the founder expertise, the pedigree. We talked about the size of the opportunity, right? Can this be $1 billion outcome? These are, quite overlapping across multiple different investors. For us, we're quite indexed on finding second time entrepreneurs, right? So founders that have built in the past, have ideally achieved some positive outcome with that, whether it's a venture outcome or not, and are now looking to build again. That's one. And then the second thing I look for is, you see the word product market fit a lot, right? Product market fit is, has the product been sold? Is there a market demand for this product, whether it's physical or software? I think a lot about founder market fit, which we've touched on already as well, but in a different way. So founder market fit is, does the founder have experience or an understanding of what this market actually takes? They may not have experience in it, but maybe they have complementary overlapping skills in this space. Um, typically finding a 2-time or 3-time entrepreneur is typically a good indicator for success in this journey. And again, the startup journey is very long. You're typically looking at, 5 to 8 years is what the West says for an exit. I think in our region, it's probably a little longer than that. You're probably looking close to the 10-year mark. So you want someone that has, the experience, the patience, the thick skin, and all those softer skills to withstand that journey.
Interesting, interesting. I think from the VC's point, sorry, I'm not a VC expert, but I think reading a people and a founder's mindset, I think this is the most difficult part also, right, in the VC journey, Mayank?
Absolutely right. And are they solving a real problem? I think a lot of people want to become entrepreneurs. It sounds cool, it sounds appetizing, it's a cool flex when you go to networking events. But fundamentally, you have to be solving a large, ideally niche problem, which is overlooked and is sticky, right? One where customers are willing to pay for you to solve their pain point.
Interesting, interesting. Thank you all the panel members for very useful insights in last 25 minutes. So we have one question from the attendee, which we would like to take it for now. Uh, there is a specific question about the company structure and cross-border investors. I believe any of these three panel members feel free to share opinion, pick up this question. So the question is around, would you recommend raising capital directly into the operating company or through an international holding structure for cross-border investors?
Very valid question. Happy to take this one, unless someone else wants to go.
Sure. Please go
I
ahead.
typically always recommend a holding company, which has, the right rules and regulations in place to protect investors. Not all um, holding type structures will accommodate for that. But typically, yes, you'd always want to raise for the holding company, particularly if you're in a vertical like fintech, where you may need to have, different operating entities in each of the markets that you're active in. Then raising at the holding company makes sense both for you as well as the investor, so that the investor gets the exposure into each of the operating entities, but also so you can then distribute out that cash accordingly, albeit it's a little expensive.
Interesting. I see a positive response from Asad's reaction also. Asad, anything on this part you want to share with?
Yeah, no, I second that. Like, even when we have companies that go through our due diligence process, like one of the main things that we tell them is to have a clean operating structure, which is usually a holdco that owns the opco, because it makes it much better for them to also raise future rounds of capital, and it's just good from a legal standpoint as well, all in all.
Interesting. Thank you. So there are a few more questions from the audience, but considering that we have time constraints for now, we will answer the questions via email, taking inputs from all the panel members and presenters. So thank you again for all the panel members to join. I'll leave it to Juno to handle the closing remarks.
Well, this turned into an honest conversation, to be honest. So, sharing insights you don't usually hear on a stage. Thank you. Thank you so much, Mr. Shwale, Mr. Durairaj, Mr. Varyani, for such an insightful and honest conversation on fundraising in this region. Also, thank you, Mr. Kapil Bhamari, for moderating the panel so well. You really pulled out some honest, practical insight from our panelists, the kind of conversation founders don't often get to hear. So that brings us to the end of today's session. And if you'd like to follow up on any of today's speakers, please reach out to us at Dubai CommerCity. We'll be glad to facilitate that connection. And don't forget to follow our YouTube channel, where we'll be sharing more sessions and updates like this one. Hoping to see you all again in our upcoming webinar. For further details, please keep an eye on your LinkedIn feed. Thank you again and have a wonderful weekend.
Thank you, Juno.
Thank
Thanks
you,
all.
everyone. Have a good one.
Thank you, you too.